Hi everyone. In this video, let us see about the reforms of the Narasimhan Committee 1 and the 2. So, in the banking sector, before going into the Narasimhan Committee reports, let me brief you about why these reports have been informed. So, because due to the banking sector reforms that were there in India, in 1990, RBI took a step in order to find out the gaps between the banking system, and then a committee has been adopted on it in order to find out the gaps between the banking sector system that is there in India. The output of that committee, let us see what the committee reported. The first phase of reforms of the banking sector, the Narasimhan Committee 1, that is the report of Narasimhan Committee, set up on August 14, 1991 to examine all aspects relating to structure, organization, function, and procedures of the financial system. Based on its recommendations, a comprehensive reform of the banking system was introduced in the financial year 1992-93, and the recommendations of the CFS Narasimhan Committee 1 were aimed at ensuring a degree of operational flexibility, internal autonomy for public sector banks in their decision-making process, and greater degree of professionalism in banking operation. And the Committee on Fiscal System, CFS, is to rebuild the financial health of commercial banks and to make their functioning efficient and profitable. And the government of India appointed a high-level committee under the chairmanship of M. Narasimhan, and the committee gave its recommendation in November 1991, which was the blueprint of the first generation banking sector reforms in India, and the objectives of the committee were given below, like to make recommendations for improving and modernizing the organizational systems and procedures as well as managerial policies, to make recommendations for infusing greater competitive viability into the system so as to enable the banks and financial institutions to respond more effectively to the emerging credit needs of the economy, and to examine the cost composition and adequacy of the capital structure of the various financial institutions, and to make suitable recommendation in this regard, and to review the relative roles of different types of financial institutions in the financial system, and to make recommendations for their balanced growth and the improvement in financial health. Is the first necessary step was to improve the financial health of banks, and these measures aimed at reducing the vulnerability of banks in the face of fluctuations in the economic environment, and these included the introduction of prudential norms more or less in keeping with international thinking, and the transparency of financial system is recommended. The committee was of the view that the balance sheets of banks and financial institutions should be made transparent, and full disclosure are made in the balance sheets as required by the International Accounting Standards Committee. And institutional strengthening. Institutional framework conducive to the development of banks need to be developed. So an important aspect of banking sector reform was to strengthen the institutional base of banking system, and these included a variety of measures such as the licensing of new banks in private sector, enabling the public sector banks to go to the market and augment their capital base, and creation of debt recovery tribunals to deal with loans owed to the commercial banks, and asset reconstruction fund. The committee suggested the setting up of an asset reconstruction fund to take over bad and doubtful assets of the balance sheets of the banks. And on directed investment, the RBI was advised not to use the CRR as a principal instrument of monetary and credit control. In place, it should rely on open market operations. And the two proposals advised regarding the CRR regarding the CRR are: CRR should be progressively reduced from the present high level of 15% to 3% to 5%, and RBI should pay interest on the CRR of banks above the basic minimum at a rate of interest equal to the level of bank's 1-year deposit. And concerning the SLR, it was advised to cut it to a minimum level from the present high level of 38% in the next 5 years. And these suggestions were directed to the goal of making more funds available to the banks, converting idle cash for use, and cutting down the interest rates banks charge on their loans. And on directed credit program, under this subtitle, the sessions revolve as directed credit program should be phased out gradually, and directed credit should not be a regular program. It should be a case of extraordinary support to certain weak sections, and concept of PSL should be redefined to include only the weakest sections of the rural communities, such as marginal farmers, rural artisans, village and cottage industries, tiny sector, and others. The redefined PSL should have 2% fixed of the aggregate bank credit, and the composition of the PSL should be reviewed after every 3 years. And on the structure of interest rates, the major recommendations are: interest rates should be broadly determined by market forces. All control of interest rates on deposits and lending to be withdrawn. Concessional rates of interest for PSL of small sizes to be phased out, and subsidies on the IRDB loans to be withdrawn. Bank rate to be the anchor rate, and all other interest rates to be closely linked to it. And the RBI to be the sole authority to simplify the structure of interest rates. And on structural reorganization of the bank, the committee suggested as substantial reduction in the number of the PSBs through mergers and acquisitions to bring out greater efficiency in banking operations, and the PSBs to be made free and autonomous, and the RBI to examine all the guidelines and directions issued to the banking system in the context of the independence and autonomy of the banks, and every PSB to go for a radical change in work technology and culture so as to become competitive internally and to be at par with the wide range of innovations taking place abroad. And finally, the appointment of the Chief Executive of Bank, CMD, was suggested not to be on political considerations but on professionalism and integrity. And the asset reconstruction companies or fund are there to tackle the menace of the higher NPAs of banks and financial institutions. And the committee suggested setting up of asset reconstruction companies, and the committee directly blamed the government of India and the Ministry of Finance for the sad state of affairs of the PSBs. And there were some of other major suggestions of the committee which made it possible to get the following things done by the government, like opening of new private sector banks permitted in 1993, and prudential norms relating to income recognition, asset classification, and provisioning by banks on the basis of objective criteria, and introduction of capital adequacy norms, simplification in the banking regulations were suggested by the committee in this asset reconstruction companies or fund. And this is the, you can see here in this Narasimhan committee report on banking sector reforms. First one is strengthening the banking sector, asset quality, systems and methods in banks, structural issues, and the technological upgradation. So these are the things that the Narasimhan committee has been advised on based on these systems of structural issues, asset qualities, and the structural technicalities of upgradations are to be done in the reports. And the banking sector reforms measures mainly are the deregulation of interest rates in order to provide operational flexibility and competitive environment to the banks, interest rates on deposits and loan advances of all commercial banks, including urban cooperative banks, have been deregulated, and controls and regulations of the RBI on interest rate has been abolished. And reduction in Reserve Bank requirements as per the recommendations of the Narasimhan Committee, the reserve requirements of the commercial banks have been drastically reduced in order to ease the availability of liquidity for credit and to enhance the role of the market forces. And measures to improve competitive efficiency in banking sector and prudential norms have been introduced, and transparency measures have been explained, and capital adequacy measures are being recommended for setting up of new and higher norms for capital adequacy, that is capital to risk weighted assets ratio. And it was recommended that capital adequacy ratio should at least be 8%. All the public sector banks were required to attain this norm by 1996. And the recent measures towards reforming banking sector are, according to the report, Trend and Progress of Banking in India, the following in 2002, the following reforms of major policy developments have been introduced in the banking sector. They are: the RBI has liberalized the norms for issues and pricing of shares by private sector banks, and the banks can issue smart cards both online and offline to select customers with good financial standing, subject to their ensuring the implementation of Know Your Customer concept. All scheduled commercial banks, excluding regional rural banks, have been advised to maintain with RBI a CRR of 5% of net demand and time liabilities with effect from June 1st, 2002. And the above are the Narasimhan Committee reports 1, and the second phase of reforms of the Narasimhan Committee 2 are, let us see this. In 1998, the government appointed yet another committee under the chairmanship of Mr. Narasimhan. It is better known as the Banking Sector Committee, and it was told to review the banking reform progress and design a program for further strengthening the financial system of India. And the committee focused on various areas such as capital adequacy, bank mergers, bank legislation, and others. And the aim was to review the progress of the implementation of the banking reforms since 1992 with the aim of further strengthening the financial institutions of India. And the report focused on issues like size of banks and the capital adequacy ratio. And this is the strengthening banks of India, and the committee considered a stronger banking system in the context of the current account convertibility, and it thought that Indian banks must be capable of handling problems regarding domestic liquidity and exchange rate management in the light of CAC, that is current account convertibility, and thus it recommended the merger of strong banks, which will have multiplier effect on the industry. And the capital adequacy ratio, in order to improve the inherent strength of the Indian banking system, the committee recommended that the government should raise the prescribed capital adequacy norms, and this will further improve their absorption capacity also. And narrow banking, those days many public sector banks were facing a problem of non-performing assets. Some of them had NPAs, whereas as high as 20% of their assets, and thus was successful rehabilitation of the base banks. It recommended narrow banking concept, where weak banks will be allowed to place their funds only in short-term and risk-free assets. And the bank ownership aspect, as it had earlier mentioned, the freedom of banks on its working and bank autonomy, it felt that the government control over the banks in the form of management and ownership, and bank autonomy does not go hand in hand, and thus it recommended a review of functions of boards and enable them to adopt professional corporate strategy. And review of banking laws. So the committee considered that there was an urgent need for reviewing and amending main laws governing Indian banking system like RBI Act, Banking Regulation Act, and the State Bank of India Act, Bank Nationalization Act, and others. And this upgradation will bring them in line with the present needs of the banking sector in India. So thank you everyone for be patient listening, and I hope these two Narasimhan Committee reports will give us an idea about how the banking sector reforms have taken place with regarding to the improvements of Indian banking system in India. Thank you, everyone.